Well, in any market, there's a tendency, and especially in small caps, that you throw the baby out with the bathwater when you get an earnings downgrade cycle. The momentum in the stock seems to be over, but that approach is short term. If you have an approach that collides with the way corporates think, which is to try to think out over the journey of a multi-year capital investment and strategy for growing businesses, you'll see that some people do throw good companies out at the bottom of the cycle, and we've found that especially in resources. We've benefited from owning Sirius, from owning PanAust, and we think that that there's been a little bit of a sea change, especially with KKR coming in to have a look at Oz Minerals. I mean, if we start getting some of these companies run for cash instead of building empires and drilling holes to build marginal new mines, then in the case of Sandfire, its debt, which is about $45 million, will be paid off in about a year, and then the following 5 years of cash flow equal pretty much the market cap of the company, and then you've got ongoing mine life after that of 2 to 3 years plus potential extension from their Monty find. So if you take a short-term approach and you just say, earnings downgrades, or the cycle's no good, then one day you just might wake up and find a company like CSR has been bid for because it's people have said that the housing boom's over. Someone might take a longer-term approach, and especially corporates from offshore, they've got low funding costs, they're struggling for organic growth. They can often see an arbitrage in getting some earnings growth from buying in foreign countries, even where they have no real in-market synergies.
Does the level of M&A activity speak to market valuations, and are market valuations in equities reasonable at the moment?
Well, I think that you have to always be concerned about the availability of cheap debt. Whether or not some of this M&A is being driven by the low cost of debt, which means that you can get an earnings arbitrage where the growth or the EPS accretion, which a lot of people focus on in M&A, is driven by the low funding costs. So you have to worry that the M&A cycle is not sustained. I mean, all M&A cycles come to an end, and principally that ends when the availability of credit or the credit funding cost goes up, and because that allows for the unsustainable valuations that you see. So you've always got to worry about it, but over the next little while, there's no foreseeable trigger for that to occur. Credit is quite available, and even though there's the prospect of higher US interest rates, they're not going to be so massive as to undermine the arbitrage that's currently going on in M&A markets.